हेलो साथीहरू नमस्ते एन्ड वेलकम अल अफ यु टु माई च्यानल। आजको डिस्कसमा हामी चाहिँ इन्भेस्टर्स बाइसेसको कुरा गर्नेछौँ। एन्ड फ्रम द बिहेभियर फाइनेन्स कन्टेक्स्ट द बेसिक एजम्पसन इज द्याट investor do not think and behave rationally, while standard finance theorists say that investor think and behave rationally. That is the basic differences, we can say that. Now based on this background, let's talk about some of the overview. Like traditional finance theories, we say that investor rationality assumption, as I discussed earlier, friends. So is the portfolio model that's which discussed by the Markowitz 1952 is the all about the risk minimizing portfolio. Similarly, capital asset pricing model as discussed by Sarpe, Linter 1965 and the Mosin 1966, while efficient market hypothesis discussed by the Pharma, which is simply which discuss about the three forms of market efficiency: strong form, semi-strong form, and the weak form of efficiency. And Pharma is also called as a father of modern finance. And next one is that is, friends, that's option pricing model, which is also known as Black Scholes model, which discussed in 1973. Now let's talk about what about the behavioral finance. It's all about investor irrationality or biases, we say that. So judgment under uncertainty, that's heuristics and the biases, as discussed in 1972 by these two authors, Tversky and the Kahneman. They are, we can say that, authority in the behavioral finance area, we can say that. Okay. Now simply prospect theory, decision under the risks. This is all about your is again the Kahneman and the Tversky 1979. Okay. Now because the market anomalies, friend, that is EMH could not explain the market anomalies. So that is the basic finding of T-Bont and the Thaler in 1985. Why, simply we can say that they opine that investors do not think and behave rationally in the real life situation as a consequences of first cognitive and the emotional biases. Okay. Now let's talk about what about the next one is that is the nature of biases. We can broadly categorize. One is the information processing biases, forecasting error, and the next one is the behavioral biases. Okay. So let's talk about what about the information processing biases, which is investor biases. We can see that simply, friends, this is errors in information processing which causes investor would misestimate the true probabilities of the possible events, or simply we can say that associated rate of returns. Okay. So this is, suppose he is a investor, he could not quantify the actual probability of occurrence, we say that. So that is simply the errors in information processing, say that. And there are the simply the four more important ones, that is forecasting errors, overconfidence, conservatism, and the representativeness. Okay. Now let's talk about what about the forecasting error. So forecasting error, simply you can understand here, friends, this is the forecasted value, that is the data from the forecasting model, like your, we can say that a time series analysis you have used it, but still when your forecasted value is less than actual value, which is the observed real world data or financial data, we say that. So this is simply forecasting error, you can understand here. So people generally give the too much weight to recent experience compared to the prior beliefs. This is also known as the, friends, that is the behavioral memory bias. Okay. So when making the forecast, that is all as discussed by Kahneman and the Tversky in 1972. Similarly, as discussed by D. Bont and the Thaler in 1990, high price earning ratio form with high price earning ratio tend to be the poor performance. That's the investment, we can say that. Okay, poor investments. So that is all about common types of forecasted error. We can say the bias. Similarly, random variability, seasonal variations, underestimations. Next one is that overestimation case. Okay. Now let's talk about what about the what about the next one? So this is forecasting error. Now let's talk about overconfidence. What about the overconfidence? Simply, you need to understand here, friends, that is the problem with the world is that intelligent people are full of doubts while stupid people are full of confidence. That means uh, they are behaving like overconfident. So simply you can say that overconfidence is simply self-assessment, which is what we think internally, but actual outcome what we actually get it. So this is the differences between the self-assessment and the actual outcome that we actually get it. So this is the overconfidence. And simply again the Kahneman and the Tversky 1982 they discuss about the confidence is the subjective probability, while that is the degree of the belief associated with the what we think will happen. That is the point. Okay. Now that means when the people are overconfident, they believe that they knew more than they in fact do know. That is a fact. Okay. Wow. Or we can say that believe their accuracy to be higher than it in fact. That means actually you believe that you know everything, but actually you don't know. So now let's talk about the overconfidence in the stock market. Okay. So this is the case. Look at this case, friends. This is the you can say this is like your technical analysis. This is technical analysis. We discuss the things. Like in this case, you say that I'm confident that this stock just watch it and rise to 1000 over next few months. So that means you try to hold the stock, but actually is that you are overconfident, but now this is the case, the stock price is down. Okay. Similarly, here you see that I told you that, but you doubted my confidence. It is never too late. So buy it now. Here you are going to buy it, and that's you are talking about long position strategy. But here you buy the stock, okay, and normally we intend to buy the stock when it is undervalued. But increasing trend, when you are buying the stock, that means probably we lose the our value of your investment. Similarly, here you are going to hold your stock. You believe that market will go up, but this is now decreasing trend. Okay. So this is all the example of overconfidence situation in the stock market. Okay. Now let's talk about what about the conservatism bias. So conservatism, you need to understand here, friends, that is the term conservatism bias refers to the investor too slow, that means too conservative. They don't want to update themselves. Just they believe that they don't want to change, you can say that, even though the new evidences came to the market. So this is the case. Yeah, you can say that when the things change, people might underreact. So tend to be slow to pick up on the changes. And because of this conservatism, we see that. Okay. Now, but if there is a long term enough pattern, then they will adjust to it and possibly we see that overreact, or there might be the case underweighting the long term average. So this is picture you can see here. Actually you are responding to the market just with the belief that you don't want to change. You are too slow. You are not going to change your investment decision just because of the prior belief or just having the conservative nature of investment, you can say that. Okay. Now let's talk about what about the sample size neglect or representativeness. So that's the when a study gives you the good indication of the what the whole population. So sample is that you draw the sample, but which could not represent the populations. Then we see that that is a poor sample size. Okay, and which could not we can't say that that is the good representative. That is simply sample size neglect bias, we can say that. So this is one of this is one of the group of heuristics or simple rules of governing the judgment or decision making. We see that again proposed by the psychologist Amos Tversky and the Daniel in the early 1970s, friends. Okay. So representative bias, you can say that cause the people to over weight recent informations, and de-emphasize the base rates or the prior beliefs. For example, they conclude that too quickly that a low object found on the street is the goal and ignore the low base rate and finding goal. That is the case. Okay. So basically, friends, we discuss about the is interesting. That's all about investor biases, and broadly I discuss about information processing and the behavioral biases, and we discuss about the information processing. Similarly, we discuss about forecasting error, overconfidence, conservatism bias, and lastly we discuss about that is the sample size neglect representativeness bias. Okay friends, these are the things that I would like to share today. If you like this content, please like, subscribe my channel, that is the Finance Guru, Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.